The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're going to give you a lot of information that you're going to need for your finances, your income taxes, and, of course, I'm joined in studio like every Saturday with my buddies. Hey, Chris Fabian.
Hello, Esther.
Hello, Christopher and Tiffany Fabian.
Hey, happy Saturday.
And
beautiful
enjoy,
Saturday.
You know, it's wonderful to see a great weekend, isn't it?
Oh, yeah. We're thinking of going to the fair later on, and so it's a great time.
And the sad thing is, you know, it's coming to an end.
Yeah.
You know, I was in Home Goods yesterday, and they got all their October stuff out. And for Halloween, I thought, oh, gosh, give it a break.
I know. We went to Home Depot, and the new things for the lawn are about 12 feet tall.
Yeah.
They're gigundous. They're huge. They're about 12 feet tall.
What are they, the inflatables?
No.
They stand.
There's just like skeletons.
And they're 12 feet tall?
They're 12 feet tall.
How do they not fall over?
They have braces, and they're holding it up. These guys were holding it up from the ceiling, right?
I don't know. I didn't look that good.
Yeah, great.
Okay, well, I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on the cell phone. You can text us at 716-8030930. First thing I want to say is interest rates are approaching 6%. There are some that are at 6%. You can get 5.75% at Maple Mark Bank for a 12-month CD, and you can get 5.55% for a 2-year CD at that same bank. So one of the benefits, of course, with them trying to control the money supply is that interest rates are raising. Now, that's not good for the federal government because that's what they have to pay to borrow money. But for you, if you've been putting less than 1% in a CD, think about breaking that CD and moving it to something that's a higher yield, 5.75. Some of them are 6% for like 6 months. And I'm thinking in the next couple of weeks it'll be at 7%. But if you need any help with that, you can call EG Tax. We'll give you the latest lowdown on what you can do. You think about it. If you have $100,000, that's almost $5,000, $6,000 extra that you have at the end of the year. So you don't want to pass this opportunity.
No, you want to be a wise steward of your money, you know?
And then the other thing is, because interest rates are so low, no banks were going to do reverse mortgages.
Right.
And a reverse mortgage is a way for you if you're a senior. And let's say you have a mortgage and you're making house payments and you're really tight. I can think of somebody very near and dear to me who it's very tight for them to make their house payment. Now that interest rates are higher, they're doing reverse mortgages again. And so I said to her, she can get, in her house, I think is worth like $500,000. I said, they'll probably give you a $400,000 line, and you can take out the money tax-free if you need it.
Yeah.
And it's basically a safety net. Otherwise, she has to sell her house. So reverse mortgages, tax-free money are back in play. And again, if you're somebody that wonders how that works, give EG Tax a call. You can give us a call here in studio, 8030930, 8030930, star 930 on a cell phone. Text us 716-8030930. And then the last thing I wanted to talk about before I get into the other stuff is that Tiffany is the offer and compromise queen. Explain, Tiff, what that is and how you help people.
Yeah, before I do that, I just want to say that one of my patients just did a reverse mortgage, and it allowed them to stay in their home. So they're definitely doing reverse mortgages in Western New York. So
I could not find, I have a client that she's just barely making it, like Social Security check to Social Security check. And during tax season, I couldn't find any any banks that were doing reverse mortgages. Now they're back because they can make money again off of reverse mortgages.
It's sad that they, you know.
And okay, so let's talk about offers and contracts.
Yep.
And how about tax school?
Tax school starts in about a month here, and the classes are free of charge. They're meet twice a week, either in the mornings or evenings. And there's also an online version. Great opportunity to learn taxes from A to Z. And the hope is that you'd come to work at one of our 32 area locations. And so that's the hope. And it's great. You'll be the hit at every party. And an offer and compromise is, so say, you know, I'm talking to a person right now and he owes about $300,000 to the federal government and about $60,000 to the state of New York. And so an offer and compromise is a doubt to collectability. So it's when, you know, it's a fresh start initiative. And so you go to the IRS and you're like, I can't pay the $300,000, but I can pay $1,000. And so it's paying pennies on the dollar. Now, it's not for everybody. It's doubt to collectability, excuse me. So if you own a house with a big asset, if you have a job that you make quite a bit of money, they would say, there's no doubt to collectability there. So you really have to be in a situation.
Or if you have a pension plan, they're not going to do it either.
Right.
But this would be somebody that really is between a rock and a hard place. And maybe they're garnishing your wages right now. That
Right.
You're still a candidate.
That's right. That's right. Absolutely. You are. So give me a call, 632-7886, and we can talk about it offline. A lot of times it's private information, and the intention is to help you. And I also like to do, you know, I was talking to an IRS rep at the Offer and Compromise Department about a month ago, and he was just, I don't know why, he just was talking to me for like 45 minutes. He was giving me a lesson in how to do offers and compromises. And I was thinking to myself, I know how to do these, but he was going on. And then he started talking about the advertisements on the radio and what scams they are. And so it was nice to hear what the IRS thinks about those offer and compromise places on the radio
Well,
that are
probably
advertising.
the employee retention credit places too. I
Yeah.
mean, if you are an employer who kept their employees going during COVID, and even if you got PPP money, you might qualify for some
Employee.
of that employee retention credit money. But remember, the burden of proof is on you to prove what the figures that they're putting down, and if it's too good to be true, it probably is. You want to make sure that you do your due diligence to make sure that you actually do qualify for the employee retention credit, which can be up to $26,000 per employee.
Right.
So that's a lot of money.
It's a lot of money. And I know what it's going to be closing when, Chris? When are those credits closing?
I couldn't tell soon. I know
Soon.
that,
That's
but
really
I don't know the exact date.
Well, it would be the statute, right? 3 years?
No, I think you have to get the application just like the PPP. It had a
Oh, it has
deadline.
a filing deadline?
Yep.
Okay. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Okay, so I want to talk about today why filing status makes a difference.
Correct.
Right?
Yep.
And a lot of people think that if you're married filing a joint return, that's the best, you get the biggest bang for your buck. And that would be true if it was that you only had one working spouse, right? But nowadays, with two working spouses who are making up the taxable income, that is not necessarily the case. What happens is the tax rate schedules adjust based upon your filing status. So I'll give you an example. If you're a single taxpayer with taxable income of $100,000, your tax liability is $17,400. If you're filing a joint return, it's $13,454, and head of the household $16,336. So you say, wow, the single person pays the most. But that would be one single person having $100,000 taxable. But if it was two people, like a husband and wife, making $100,000, maybe $50,000 taxable apiece, well, that tax liability drops to $13,246. It's $200 less than filing a joint return.
That's right.
And what happens is It's like the federal government has said, well, we'd rather have single people live together than a married couple.
Yeah.
And you're going to pay more if you're filing a joint return than
Yeah.
if you were two singles. And I'm going to go through some of those things after the break. So we're going to take a short break. I'm Esther Gillius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us, 716-8030930. We're going to make you smarter than the average bear on the other side. Thank you. Hey, to us, you are family, and I'm Esther Gillius, the tax lady from EG Tax. Our corporate office is open Monday through Friday from 9 to 5. We make evening and Saturday appointments for you until it's tax season. Then we're just always open, except for Sunday. So we want to help you. Here it is, the middle of August. We don't have very many months left to go till the end of the year, and we want to make sure that we minimize your tax liability if we can. And if you want to come in for a free consultation, be our guest. We would love to help you. Now we have Mark, who's been waiting. Hi, can we help you, Mark?
Hi, I'm also part of the EG Tax family. You guys.
Yay for Mark!
Hey, I've got a question, Esther, Tiffany, for you guys. My mother, who's in her early 90s, has her home, and she asked me the other day, would it be better to put the home in the name of the family, of the kids, or it'd be better to put it into a trust? What do you think?
Good question.
Okay, so what you should consider doing, remember, there's the 5-year look back. So if she puts your name on the title, and upon her death, because it was gifted to you, rather than as going through a life estate, whatever mom paid for the house plus improvements and a stepped-up basis had your dad passed away prior to her gifting the house, that's going to be your basis, and you're going to pay a lot more taxes. However, if you do a life estate, then over a 5-year period, the house is gifted to you a little at a time. Actually, not gifted. Basically, you start to take ownership a little at a time, and over a 5-year period, the house ends up being yours. It goes. It's called a life estate. You get a stepped-up basis upon her death, and you don't pay taxes over what it was worth from the date of her death till the time you sell it, assuming that's fairly a short period of time. So, I think most people would think
that's the answer.
The life estate would be the best thing to do.
Yeah, and so you'd want to usually consult with a lawyer or they could help you set it up. Jeff Katz is a great option. His phone number is 716-633-3363.
Let me write that down. Could you give that to me again?
Sure, 716-633-3363.
Got it. All right, guys. Well, thank you so very much for
All
your
right.
help.
Well,
That's
thanks
great.
for listening.
Hey,
Have a great day.
Mark's question makes me somebody asked me, a client asked me a question yesterday. See if I answered this correctly. So she called me, Chris and Esther, because her dad is going to gift her $150,000, and so she wanted to know about doing a gift tax and things like that. And then, so this person is around 48 years old. And then she said her dad was thinking of also putting the house in his name. And my advice to her was it wouldn't be good in case he ever had to go into a nursing home. Did I give good advice there?
Well, first of all, we know that unless your estate is approaching $13 million,
Right.
there is going to be no estate taxes due upon your death on the federal. There would be it's a lower figure for the state of New York. So the only reason that they put that $17,000 limit in there is you don't have to file a gift tax return if you give $17,000 or less per person per year. So you could give $17,000 to Smith, to Sammy, to Laura, to Joanna, to people on the street, and not have to file a gift tax return. But if you do more than 17, then you do a gift tax return, which then puts the IRS on notice that you've been giving away part of your estate, and upon your death, part of that unified exclusion would be taken away because you had given more than $17,000 per person per year.
And what about her dad right, that's what I told her. What about her dad putting that name on the new house?
So her dad being older, I'm assuming, and because he's her dad. That's true. If there's ever a problem with ability to go into a nursing home, that asset that you just put your dad's name on then becomes something that they would expect to be used to pay for Medicaid instead of Medicaid if you don't have the money to pay. So most people, as they're older, are trying to get rid of assets, not put them in their name because of the whole Medicaid thing. Okay. Now, if you have a lot of money, and let's say you have $1 million, and at 5% interest, you have $50,000 a year coming in, and you don't need to even worry about Medicaid, then it's not a problem for you. But most people are not in that boat.
Okay, I gave good advice.
I know you would.
Yeah.
Would you agree, Chris?
I would agree.
And then I had another client call me yesterday with a question. You want me to ask that too?
Sure.
So this is a married couple, and they're about 59 years old. The husband retired early from the VA, and they have some kids in college still. And she doesn't work, and so he works part-time as a teacher's aide. He makes around $5,000 or $6,000 a year. And so her question to me is getting the college credit for the 20-year-old. Will they get it? And I explained that. But then her other question is they always put money into a 529 and then draw from it and use it to pay college. She's wondering if she should do it this year. And I told her no, because the pension is a VA pension. It's all tax-free.
Free, right.
And so they would not be able to take the advantage of the 529.
Except for the appreciation, which is not going to be taxable. And one would assume that with interest rates rising, that there's a better return on your 529 as well. But it's true. If you don't have any the 529 is a way of putting money into a pension, so to speak, almost like a pension, for your beneficiaries to go to college, and the appreciation on that money that you put into the 529 grows tax-free if you use it for higher education, and it's a deduction on the state of New York. Well, since it's only a deduction on New York State, and they're not going to pay taxes on New York State, it becomes what Tiffany's saying, a moot point. So
right.
The whole thing is always ask.
That's what I was
going to
say. That's what I was going to say, right, Chris? Wouldn't you agree?
Yes, definitely ask, because, especially if they're just putting it in and taking it out a month later, you're not going to gain that much money. Don't even bother. Just put it in the bank and earn that 6% that way for that month.
Good point.
Absolutely.
Good point.
Okay, so I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone, 716-8030930. And so, okay, let's talk about, you would think that if you're married filing a joint return, that's the most preferential way to file a return. And it can be, like I said, if it's just if there's just one wage earner in the family, you're kind of getting a benefit for the spouse. But here's some of the disparities that are in the tax law. If you're single, you don't pay taxes until your income, including half your Social Security, exceeds $25,000. If you're filing a joint return, that's $32,000. So you say, oh, well, Esther, that's more money. That's two people.
Right.
If there were two people living in the household without benefit of marriage, then he would get $25,000 and she would get $25,000 as a floor. That's $50,000. So in that case, $18,000 less of Social Security would be taxed.
How is that fair? That's when we talked about the marriage penalty, and so
well, that is the marriage penalty.
That is the marriage penalty. But there was talk about 10, 15 years ago about fixing it, but they really never fixed it.
They fixed a lot of it. I mean, the standard deduction is the same.
Right.
The phase out for child tax credits are the same. But these are the areas where it's not the same. And Social Security, how many years has it been 25 and 32? Like since
Forever?
the beginning of time. Right?
As far as long as I remember.
But two singles would have a floor of 25 each, or 50,000. One couple would be 32. So you'd have an $18,000 benefit for two people living together without benefit of marriage.
Yeah. Yeah.
That's a big deal.
That's a big deal.
All right.
And so a lot of people, too, they wait until their kids are out of college because the one person who's not married but living together will get the advantage of a FAFSA or Pell or the New York State college, what do we call that, the Excelsior. And so they just wait for the kids to be out of college.
Right.
That's
Plus,
true. Well, that's true.
Plus, with, you just talked about Social Security, but you have two older people living together who aren't married, and the house is in only one of their names, they may qualify for the enhanced star. But if they get married, their incomes will be too high, so then they lose the enhanced star.
Absolutely. I mean, these are all the things people have to be, we want to tune you in on. Here's another one. The earned income credit phases out if you're single between $44,000 and $54,000.
Right.
If you're filing a joint return, it's $50,000 to $60,000. But if two single people are living there with children without benefit of marriage, that's $88,000 to $108,000 if you're single.
Yeah.
Versus the $60,000 if you're filing a joint return. That's a $48,000 benefit.
Crazy.
Where you still qualify for the earned income credit.
It's so funny. Sometimes, Chris and Esther, I'll have a client, a couple with me, and it seems like maybe she wants to get married. And so she's like, so can you tell me what would be the advantage if we get married? Oh, no. Not a lot of advantage, but I say it's biblical,
Right. Well, I mean, the advantage would be the Social Security when you're older, because you would get half. And now with both spouses working, that isn't so much the case anymore. But if you had a lower
Well, why don't we
earning-
talk more about
I
this
know I
after the
got a
news?
break for the news. I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on a cell phone. We're going to break for the news. We'll be with you on the other side.
We are family. I got all my sisters.
Hey, to us, you are family, and we're just wishing you a wonderful Saturday. Are the Bills playing tomorrow, Chris?
They're playing tonight.
But you got to play the Bills song, Frankie.
Yeah,
We
you
got
gotta
one more
play
break.
Okay.
Yeah, we got one more.
I'm excited.
Yeah, I mean, who are you playing?
Pittsburgh.
It's a preseason game.
Is it can we win?
Yeah, we can. We should. It doesn't matter. It's just preseason.
I know it doesn't
A win
matter,
is a
but
win, though.
Somehow winning always matters.
Right.
All right, I'm Esther Gullius, the tax lady from EG Tax.
And some
We
of our
have-
starters are going to be starting. Which
Our
is
starters are starting?
some of them, yeah.
All right.
It gets
and
nervous.
So we
They
have,
get
we have some
nervous.
text, Tiff?
Yep. The first one is Esther and Gang. Did the child care credit drop when I just filed? And will it go up again in 2023? Child care is so costly.
It really is. And
Yeah.
no, there's no change it went down. It went from that gigantic credit refundable in 2021 to all the way back down to what it was in 2020. And that's the way it's changing. It is, unless Congress does something before the end of the year. Now, we're going to an IRS seminar in about 10 days. And if there's any change, of course, we'll let you know. But right now, nothing's happening.
Yeah.
So no, terrible, but that's the way it is.
Yeah, and so it might be advantageous at your work if you have a
flexible spending.
spending
Yeah.
account to put the money into the flexible spending account and take advantage of things that way. So call us
You
if
get
you
a little larger deduction that way.
Yeah, so-
not a lot, but every penny helps, and that's what we're here for.
Yep,
Right?
correct.
All right, and then what else we got?
Please explain the difference in cost to get a HELOC or a reverse mortgage.
Okay, so one is a home equity credit line that you have to pay that you don't pay taxes on when you take it out, but you have to pay it back. A reverse mortgage actually means that you can have terrible credit as long as you have equity in your home and you're over the age of 62, then they will give you no questions asked, don't have to pay it back, is not going to be taxable. A loan against the equity in your home, you can take it out when you need it. You can take out a lump sum of money. You can take it out per month, however you want to do it. And if you have presently a mortgage on your house, they will pay off that first mortgage, and whatever the rest of the equity is after that, they will give you your checkbook or loan you the cash, whichever you prefer.
And Chris, I think the fees for the HELOC aren't that much, right? Were they that much?
Depends on the bank.
Yeah.
But again, you have to pay back a home equity
Right.
credit line.
yeah, and Jesse.
But remember, on a reverse mortgage, you don't pay it back, but the equity in your house is going away a little at a time.
Right. So now I'm going to be the average person out there going, well, okay, what happens when I die and I have this reverse mortgage on the house? What happens to my kids?
Whatever is left.
Like, do they get
go-
the house? Do they have to pay it back?
Whatever is left, the kids have the right then to sell the house to pay off that balance on the reverse mortgage, and the rest of the money would go to them. But obviously, the reverse mortgage, this is the bad part of it, is that it's eating up your equity. But there are some people, I can think of a very close friend of mine who can't afford to live in this house. She said her kids don't want her money, and she wants to live where she's living, and she's in excellent health. And so a home reverse mortgage might be something that would be good for her. It's not for everyone.
And-
You got to think about it before you do it. But if you're between a rock and a hard place, it can be really like an answer to prayer.
And I believe you said it was Mutual of Omaha that had it?
There's a number of them right now.
Oh, okay.
I didn't.
Okay.
I wasn't prepared to look that up, but I will look it up, and we can post it on our website.
Yeah, and then
Yes.
also if you're thinking of a home equity line of credit, which is really a nice option right now, because the interest rates for mortgages are so high, and so refinancing is not really such a great idea. But Jesse from Cross State Funding, he does home equities, and he's always somebody good to talk to. I've got his number. I don't know if you have his office number, but I've got a number of 984-6968. And so Jesse at Cross State Funding might be a good option if you're thinking of a home equity line of credit.
Right, but now remember, the interest is not deductible. Because
Unless
in
you
order,
use it to
in
fix
order
your
to
house.
use the interest as a deduction, it has to be something to improve or become part of a capital improvement to your personal residence.
Right. And the reason somebody would do a HELOC right now is because, like, me and my wife, our mortgage rate is 2.5%. Why would we refinance a mortgage?
Absolutely, that's a good point, Chris. So, but let's say you want to get rid of 25% credit card debt,
Right.
right? And I just heard a report the other day that Americans have run up credit cards larger than any other time in history right now, because I think everybody's kind of robbing Peter to pay Paul. So if you're at the max on your credit cards and you just can't stand it anymore, a home equity credit line would be a great idea, because it's like 7% versus 25%. Then take those credit cards and cut them up and just keep one in the freezer and turn inside of a block of ice, so that you really can't use it easy,
Right. And how long do you think before the credit card companies go, well, wait, you guys keep raising the interest rates that you're getting. Why can't we raise ours to over 30%?
Well,
You
they
know.
probably will.
I mean,
They probably will. I mean, it's really a problem. And the other report that I heard this week was that the borrowing against your 401k, which we talked about, is such a good way to get money rather than taking it out of your pension plan. This is also at the tipping point for the highest amount of borrowed against 401k money that people need in order to make ends meet.
Right, right.
I mean,
Wow.
I said the other day, like $3 for a dozen eggs. You got to be kidding.
Yep. Yeah.
Right?
Gas
Thank
prices
God
are
I
going
don't
up.
cook.
Heating. Well, going out to a restaurant. Chris and I, we go to restaurants. Right now, our counters are getting done, so we've been going to restaurants more frequently.
Oh, Tiff, come on. Come on, Tiff. Tiff, you don't cook when you have
mother's
countertop.
like daughter.
Your daughter cooks, though.
She does. But anyways, we've been going to restaurants, and there's not as many people eating out, I have found. What do you think, Chris? I've been going. Yesterday at the restaurant, I had hardly any people in it. You think there's more competition, is what you said.
I think there's more competition. Yeah.
Well,
Where we
whatever.
were yesterday. But
Where
yes.
were you?
On Main Street in Williamsville.
Oh, okay.
Yeah.
All right. Going back to what we were talking about, the disparaging difference between two singles living together and a married couple filing a joint return. You can put money into a Roth IRA if your income is 204 to 214 if you're filing a joint return. Two singles can go up to 258,000.
Yeah.
So there you go.
Yeah.
And another $44,000 spread. Passive loss phase out. When you have rental property, you're not allowed to take a loss on your rental property if your income exceeds $150,000 and the maximum loss is $100,000. Well, if that would be a married couple, right?
Right.
But if you were two singles, you could do you could both have income of $150,000. That's $300,000, and you could both take losses up to $100,000.
That's right. Yeah.
So that's another thing.
Yeah.
And salt. Are we talking about table salt? What kind of salt?
Chris was saying, he's like, if somebody was listening to the show, they'd say, Esther, are you for or against marriage? And on the break we were talking.
I'm for everything that it's the way it's supposed to be.
Right.
But I'm pointing this out because the only way that you can get Congress to even hear is if people go and start saying, wait a minute, you should eliminate the marriage penalty.
Yeah. Yeah.
I mean, having a mom and a dad, having a marriage where you have your kids and everybody's working hard, that would be something you should reward, one would assume.
Yeah,
right?
that's right.
All right. And so in the salt deduction, Chris, what is that?
Yeah, SALT is your state and local taxes on your Schedule A. So your property tax is your state withholding. For a single person, that's $10,000. For a married couple, that's $10,000. But
So
go ahead.
Go on. No,
If
go
they're
on.
two single people, they don't get married. They each get a SALT of $10,000 for a
Right.
total of $20,000.
Right. So it's a great benefit, right?
Yep.
Being single, And Tiffany's right. Many times people say to me, so we're going to get married, and how much will we save in taxes? Okay. You're going to have children?
Drop the
That's
mic.
the good. The kids are the good deduction. Anyway, I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 in the cell phone. You can text us at 716-8030930. We're going to take a short break, and we'll be back with your comments and your calls after the break.
The bills make me wanna shout. Kick your heels up and shout. Throw your hands up and shout. Throw your head back and shout. Come on now, the bills are making it happen.
I'm so happy it's almost fall just for that.
So you can
sort of.
wait. So you can hide in a closet.
I know
on
that's
some-
true. That's true. I was with a doctor the other day, and he is a former UB guy, and he's in Florida now, and he was saying. He says, once you're in Buffalo, you can't love anything but the Bills. But he said that time, do you remember the 15-second screw-up when we were playing Mahomes in
Yes.
Kansas City? He said, when they lost that one, he said, I cried.
Oh, yeah. I have
I
cried.
said, I cried too.
I have
I
cried.
cried too. But anyway, we love the Bills.
At the time that we were about to advance in the playoffs, and there was a few seconds.
That was
that.
Yeah.
I cried.
That's it.
That was
Yeah.
it. I
I'll
cried.
tell ya. Okay, more things that are.
I had PTSD from that one.
In favor of being two singles. You pay AMT if you were a couple. If you have two singles living together, you don't pay AMT until your adjusted gross income comes to $150,000. If you are a married couple, it's $118,000. The 3.8% net investment tax that they charge you. If you are two singles, it's $400,000. If you're married filing a joint return, it's $250,000. I mean, that's right. The $150,000 at 3.8%. That's a lot of money.
It's
a lot of money. The premium tax credit, which is a refund because you're paying your own health insurance, talking about Brian Ferracci, and you would get that if your two singles would be up to $26,000 in income, but if you're married filing a joint return, you don't get that and qualify unless it's 17. So again, another $9,000 penalty for being married. And so the reason I bring it up is that knowledge is power. And so when you're listening to all of the rhetoric, all the politicians that are going to be bloviating all over the news here pretty soon, listen intently, because so many times they don't even know the tax law. I don't think they know the tax law.
I don't think so.
Right? All right.
It's hard this time of year, all these politics. It's just really
And the other day I
droning.
was, and by the way, I'm talking about two singles living together, right? And without benefit of marriage. If that one of them qualifies for head of the household, that's even a bigger benefit
my gosh.
than two singles.
Absolutely.
Right? So if you had
Children.
a kid involved, it just blows it out of the water.
Yeah.
So there is a gigantic tax penalty throughout the tax code if you're married filing a joint return.
Yeah, I know. I mean, the filing test is so important. I know I was just doing a return for somebody, and her husband moved to a different state, and he just abandoned the family. And she's like, I don't know what I'm going to do. I know I'm going to get hurt on taxes. And I'm thinking, well, you're married separate.
man.
But then I'm like, wait, when did
Abandoned
he
spouse ruling.
when did he move?
Yep.
And so I was able to do head of household.
Yep.
So it saved it got her a $7,000 refund instead of nothing.
That's right. So if you're planning on abandoning, your spouse is planning on abandoning you and you have children, make sure that they go before the beginning of June.
And I gotta
Beginning of July.
tell one of my favorite stories. So, there was one of my patients, and she went to one of our competitors, and her sister is in the house, and she has another sister and two other brothers, and they're all disabled in the household. And the one sister works, and the competition did her as single. And so I amended all her returns, and she got like
Because she's head of the household.
$30,000 back, and it was
that's
just
great.
And
between the federal and the state.
And just so you know, we don't call our clients patients. Tip is also an
Doctor.
NP.
Yes.
So
Yes.
Okay, so and the other
That's
thing
funny.
is, if I was with a lady the other day and she was saying that she works for a company, and I said, "Are you self-employed or are you an employee?" She said, "Well, I think we should be employees, but they pay me 100% of my wages as a gross check, and they aren't taking taxes out." What do you think about that, Tiff and Chris?
That's not good, because if they had kids, for instance, they would have qualified for earned income credit. They've got to pay money into Social Security if they had wages. And
well, it's self-employment. It still would qualify, but the big thing is
Yeah.
they're paying all the Social Security.
yeah.
But
There's
under the
no-
law, can the employer do that?
No, you
No.
got to have fair equity. You have to have wages. You have to pay
So
wages. in
when
order to
people say to
incorporate.
you, "Oh, well, my employer doesn't want to withhold taxes," that doesn't mean any. That means they're in violation of the law, because there's wage and hour laws that are on the books that say, if you're performing a service and they're exercising control, you're using their desks, you can't have somebody substitute services. You're working for just one person. You don't hold yourself out for anybody else. You are an employee to work for somebody else. You're an employee of that person, common law employee, which means that employer has to provide you with unemployment and match your FICA and Medicare. And if they don't, then that's a big wage and hour problem, right?
Yep. And you can always do an SS8 with the IRS, and they will do a determination on that employer. Your employer may not like it.
What is an SS8?
It's a determination of worker status for purposes of federal taxation.
So break it down. That would be you.
Do you have to divulge who you are?
And so what that form is that
I mean,
you're
it's
saying
almost like a reverse whistleblower.
you're
right?
saying that your employer paid you wrong, and so the IRS will make that determination, right? And which is really nice. And the only problem is that, like Esther said, then that
Yeah, you have there's a spot for worker's name and all that. So you could blame a coworker, not yourself.
No, but the bottom line is, all employers would rather not have to pay unemployment and FICA and Medicare.
Yeah,
I
but-
mean, because that employer would save like 12 or 13%
But-
on their wages.
Yeah, the jig is up if that employee gets hurt on the job, then they can't file and get compensation. And then also that employee wouldn't be eligible for family leave. And so there's all these other things that are
Well,
really...
that's from the the employee standpoint, but the employer cannot pay an employee as if they're self-employed just because the employer doesn't want to pay the FICA and the workers' comp and unemployment. That doesn't hold any water.
Plus-
There's common law employee rules, and that person has to be paid on a W-2. And if you're listening and you aren't paid on a W-2 and they're paying you like you're a freelancer, and you know you're an employee, you can talk to New York State wage and hour. You can, like Chris says, you can fill out the SSH form and turn in your employer. The only bad part is you are turning in your employer.
Right? So you may lose your job. But, but the thing is, the employer, and they might think they're getting away with stuff by doing it because they're not paying taxes, the payroll taxes and the Social Security, like you said, and the unemployment insurance and disability insurance. But if they were to get caught, workman's comp penalty is $190 a day per employee
Yep. So if that
for
person got
all the
hurt on
time
the
that
job,
you didn't pay.
for all
right?
the time you didn't pay it.
So if you've been in business for 5 years, it's going to be $190 a day per employee for 5 years.
Right.
In other words, you're going to be out of business.
Yes. Yep. So you
So,
think
especially if you're starting a small business, if you're somebody that doesn't know about payroll and you're confused, and so you think, well, I'm just going to write them a check. Give EG Tax a call. We'll help you.
right.
Yeah, and it's so funny. The other day I was in East Aurora and I was eating lunch, and I heard these two girls talking, and they're talking about her boyfriend, and she goes, "Yeah, he has a great job during the winter." And the other one goes, "Well, what about the summer?" "Oh, his boss told him go get a job under the table."
Yeah.
I mean, they don't. That sounds really good. Oh, I'll get all this money tax free. But when you're 66 and you go to collect Social Security, you're going to have nothing there.
And the person paying that person under the table, let's say they get paid $20,000 under the table. That means there's $20,000 left on the person that's paying theirs Schedule C, which means that the person writing the check that is under the table is going to end up paying the taxes. And so you're just not doing yourself a favor. Put people on payroll. It's not hard to do, and we are very happy to help you, especially if you're starting a small business. It's so important to get straightened out and do everything right from the get-go. Right?
Amen.
Absolutely.
All right. So during the week, if you're getting any love letters, if you owe the IRS money, they're sending you bills. Don't just pay them. Give EG Tax a call. We'll be very happy to look at it to make sure that there hasn't been something like, for instance, sale of stock that you didn't report and it has a cost basis, so you don't owe what it says that you owe. That same thing, federal or New York State. If you aren't our client, we still help you,
Correct.
right?
Absolutely.
Okay, you guys got any parting words of wisdom for people?
Well, also, we started talking about filing statuses, and, is married joint better than married separate? Well,
Sometimes and sometimes not.
right. It depends. If you don't trust your spouse, like my client will say, the husband had a business and she didn't trust his books, you would want to file separate, because if you file joint, you're
You'd be equally
responsible.
liable, right?
Yep. Yep.
Another thing I want to talk about before we go is if you're somebody that's looking for the electric vehicle credit and you don't know how that all works, you can give us a call, because sometimes people that have no liability, and many people don't even realize they have no liability, that whole potential $7,500 credit, you won't get it at all because you have no liability. So there's two things you can do. Either pull out some taxable income, like from an IRA or a pension plan, number one, or go to the dealer, because that's a fully tradable credit and negotiate with the dealer so they put the $7,500 down towards the purchase price of the car.
Yeah, I noticed. I did see a commercial for an e-car for a lease, and it did say after dealership gets the $7,500.
And $2,000 New York State too.
Yep.
So it's $9,500 potentially. So if you're going to be getting the electronic vehicle, give EG Tax a call. We'll be very happy to help you with that. And if you're interested in tax school, you can go onto our website at egtax.com. You can fill out the application for tax school right online, or you can download it and send it in. What else? Anything else?
Don't forget our school starting.
Yep. In October.
Yep. The letters, letters come all year. You know, what I'm seeing now are people saying, I didn't get my refund. I didn't get my refund.
You said that.
And when we call the IRS, they're like, well, didn't you
That's
get
right.
the CP 1234, whatever number it was? And they're like, no, what is it? Oh, well, that's where you have to verify yourself.
Yeah.
And so then they have to mail them another letter because there's a code on it.
Yeah, I got to do that. I had lunch yesterday with a client of mine who said she had to verify, and they said, I think you're entitled to an extra $3,000. Her husband has dementia, and he didn't remember how much he sent into the IRS, so we got to do that on Monday ourselves. But in the meantime, we hope you have a wonderful weekend. Go Bills. I'm Esther Gillius, the tax lady from EG Tax, with Christopher Fabian, Tiffany Fabian. Have a great rest of the weekend, and thanks for listening.